Well, welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Eric Nelson. He's a real estate investor, coach, and founder of Wild Oak Capital. He started in single-family homes and over the past 12 years has grown his portfolio to more than 1,000 multifamily units. Eric is originally from Colorado, but he now lives in Spain with his family, where he continues to invest and coach other motivated investors through his mastermind, Cash Flow to Freedom. Eric, thank you so much for being on the show today.
Thanks for having me. My honor. My pleasure to be here. Appreciate you having me. This should be fun. I'm excited.
Yes. So give us a little background on yourself. I gave kind of some broad strokes there, but of yourself, both personally and professionally, prior to getting in real estate investing and prior to getting into syndication, which I think you said was 2019.
Yeah. So I grew up in Colorado, and it's like a lot of people. I don't know that I knew any other path other than go to college. It's basically what my parents told me to do. Right. So I happen to be pretty good at math. And so lots of people just sort of pushed me towards engineering. I mean, that's kind of the best way I can describe it. Not that there was like any ill will. People were just trying to help me out. But so I went to college, studied engineering. Honestly, didn't really like it in college, and I didn't really love it after college. I wasn't really like into it. I made some money and it was fine. And so I started my own business thinking, okay, if I'm the boss, at least I might enjoy it more. Which was partially true. Had some success, but I started doing the math of basically like, what does my retirement look like, and how long do I have to do this until I can retire? It was pretty bleak. I was like, oh my gosh, I have to do this for another 30 years before I can really retire. And I was like, okay, I got to find something else. So that's when I really just started looking around. And it doesn't take you much research to find real estate as an alternative kind of investment opportunity. And so for me, you get a lot of tips along the way, but a friend of mine said, hey, check out Bigger Pockets. And that's a lot of people's story, I think, just like learning podcasts, books. I dove away and I was just like, all right, let's learn everything I can. And then I started investing in single family homes near my house. And I didn't really know of any other way. I was just kind of doing that. I got really into creative financing. I got really into seller financing. And so we started to scale a little bit. Like, I bought a sixplex on complete owner financing with 97% leverage. So I'm not suggesting everyone does, but that's a really cool story. I'm happy to share if we have time. But that was the kind of thing I was doing to scale. And then a friend of mine invited me to a meetup. So I went to the meetup, and the guy there was doing syndication, which I didn't know what that was at the time. And, the more I got to know him, the more I got to know what it was. It took me a long time. Don't get me wrong. I was like, no, I don't want partners. I don't want to do any of that. I don't want investors. I kind of came around to the idea of, okay, actually this does, suit my personality, suit my skill set pretty well. And it's a way to scale and also provide really good returns for investors, assuming you're picking good deals, right? So I just kind of was like, all right, let's give it a shot. And it kind of just dipped my toes slowly. We did 1 deal, 2 deals, 3 deals. And like a lot of things, it just sort of took off. I mean, I wanted to scale, but with the right team, the right people, the right seats, it just kind of went pretty fast. And, I wouldn't change it. I'm just saying I went from doing single families to 1,000 units within 2 or 3 years. And that's awesome, but it's not for the faint of heart either. I mean, we had a lot of things that were like in the air. And so lately, within the last year or so, I decided, hey, I wish I had a few things that I didn't have. And so I started a mastermind and like a little course and some coaching to help people kind of learn about what syndication is. Because really, I mean, I had a great coach. I think you need a coach or mentor or a group or something, in my opinion. But I just was missing some stuff. And so that's kind of the full story is, engineer by trade, started doing some real estate, eventually scaled that, quit my engineering job, scaled a little bit more. And then my family and I moved to Spain and moved here about 14 months ago. And our kids are in school here, and we're just kind of experiencing a different pace of life and different style and different culture, and really feel blessed to be here. So that's kind of the whole story. Hopefully I didn't blabber your ear off there.
No, that's perfect. So before we get into syndication, and definitely we'll get into where you are now and where you're living now, but I think seller financing is an interesting thing because obviously everybody knows real estate is a capital intensive business. It is what it is. And it's just something that obviously people starting off sometimes don't have boatloads of cash and they're trying to make win-win situations. Can you tell us a little bit about how you started getting into seller financing and how you normally structure those deals? And yeah, I mean, obviously buying a commercial multifamily property with 97% loan to value is pretty great.
Yeah, I mean, I'll do a backup because I don't know your audience that well. So I'll just say seller financing basically means the seller acts like the bank. And they can only basically, I mean, there are some things around it, Pace Morby does reps and there's other things out there, but a true seller finance is basically whatever equity they have in the house, they can carry that amount, so to speak. So let's just take a simple example. If someone inherits a house and it's worth $100,000. They could, instead of a bank, they could act like the bank for you. So you could say, hey, how about I give you 10 grand in cash? You act like the bank with 90% or $90,000 or 90% carry, and I'll pay you a monthly payment. And some people say, well, what's in it for the seller? Well, for a lot of sellers, they want that monthly payment. So in that example, someone maybe inherited the house, or maybe they're older and they've paid off their house. They don't want to worry about how to invest that money. They just want a monthly check. So if you offer them a decent return and then you get a monthly check to them, that's kind of nice. Plus they can defer some taxes, right? So if you give someone a $100,000 check, especially like an older generation, they're like, well, I don't really want to pay the tax bill on this come April either. So you say, okay, well, let's spread it out over some years and it's more manageable. Plus you're getting a monthly income. You don't have to worry about where to invest it. It's very like repetitive. Every month is the same number. So that's what's in it for them. And then the other thing is they have a lien, right? So if something happens to you or you can't service the debt, meaning you can't pay your loan, they get that house back. And in a lot of cases, you've either paid them a lot along the way or improved the house or both. So they get an improved version of what they already owned before. So they kind of know like, all right, well, sweet, I'm the bank. I get monthly payments. I don't have this giant tax bill. I don't have to worry about where to like invest this money. My recourse is the house I already owned. That's kind of sweet too. For you as the investor, like in my case, first of all, I was out of money, right? So you do a handful of deals. And to your point, I was like, my wife and I don't have any more cash. What can we possibly do? So we had to leverage pretty high. And I will say to your audience, going really high leverage is extremely risky if you don't know what you're doing or if you're not getting a deal. So in the case where I bought the $1 million property, and if you have time, I'll just tell the story quickly, Charles. Okay. Basically what I was doing early on was we just had a baby. So I'd walk him along the streets every day and I would just walk the streets of the town I lived in, any for sale sign or for rent sign. I would just call almost to pass the time because I'm just walking my son, right? And I'd be like, hey, I see your house is for rent. I'm not looking to rent, but I'm looking to buy. Would you consider selling? And that was just honestly like my original tactic. I didn't know that there's all these mailers and better tactics to do this, but it worked really well because people were like, oh, like a real person's calling. You're really interested. I'm standing in front of the house. I'm a real buyer. And so that was kind of how I got my leads early on. So this particular deal is obviously a multiplex. And the gentleman was there, he's standing in the yard and he was putting up a for rent sign. And I was like, oh, hey, how you doing? Looks like a nice place. Would you consider selling? And he was like, yeah, but I have to think on the price. And I was like, oh yeah, no sweat. Like call me and figure out what you want to do. So he called me back and he was like, he gave me this number. He said, well, I think I need $1 million. And he's an older gentleman. So I think he thought that's an enormous number. There's no way I'd go for that, but he just kind of went for it. I was like, all right, here's the reality is where I'm from in Southwest Colorado. That's actually a really good deal for a sixplex. So I was like, hey, I'm not going to argue with you at all. I will pay that price, but would you sell or carry? And he's like, what's that? And so I just kind of gave him the spiel I just gave you. And I said, talk to your lawyer, talk to whoever you want to talk to. And here are the pros and cons. Here's the risks. And if you would do that, then we could give you about $30,000 in cash if you'd carry the rest. And he was like, okay, well, let me talk to my attorney. Quite honestly, his attorney wasn't really happy with the deal because he's like, this is pretty over leveraged, right? But he's like, okay, cool. If you want to do it, let's go for it. So we bought that deal and we improved it very quickly. We put all the remaining cash we possibly had into that deal, improved it, got rents up. And then what the coolest part about that story is I was paying him more in a mortgage than he was making in his rents because his rents were so low and so out of date. So it was just a really cool scenario for both of us. He's like, wait, you're going to give me more than I was already making. I don't have to do anything. I was like, absolutely. So that's kind of what happened. And there's actually more to that story. But basically what I'll say is if you know what you're doing and you're comfortable with that risk, you can leverage pretty high in some cases. You don't have to either. I mean, you can just do like an 80% loan to value with seller carry, and sometimes they'll give you a better rate too. The other thing is you don't have to go to the bank. Not that I dislike banks, but the lending process can take a long time and can be frustrating and it's paperwork intensive and blah, blah, blah. So seller carry can be easier in a lot of ways too.
Yeah, no, that's fantastic. What I found out with doing seller financing deals is that there's really like three things that you have to like figure out what is most important for the seller. It's the price, the down payment, the interest rate, what they really want. And I found before, like when putting out offers on seller financing, I can go like my own simple thinking is I can go like 5% over what I would normally pay from a bank because I'm avoiding all the junk fees from the bank. I mean, there's
Totally true.
I mean, check out your HUD-1 when your closing statement next time you buy a property, everything in there. I mean, it's just like, it's everything is just like, you can just avoid it.
Yeah, it's like processing fee, it's documentation fee, it's the lender's fee. It's true. It can be an
FedEx,
enormous number.
It's coffee. It's like the whole, I mean, it's overnight FedEx. It's $70, whatever it is. It's just insane. So you do it and you're like, you know what? I'd rather pay, if I was going to pay $950, pay, $1 million for it, whatever it is. And you're just like, this is the deal that what you get, you know what I mean? This is like what I can work on for him. It was the price he got. So that's number one. That was it for you. But also with your, going back to your original, kind of your original example, like $100,000 for the house you sell for $100,000, you literally could probably find an investor that'll pay you 105 or 110 for that house and being able to go in with 10%. You know what I mean? Because you have that difference that they're willing to overpay a little bit for the ability of not having to deal with the bank, you know what I mean? And all that goes in with that. So there's so many different benefits of it. One question I have before we move on is when you were calling, when you're setting up these deals, when you're calling, walking around your neighborhood, did you successfully ever do it through brokers or was it all direct to owner when you did successful seller financing deals?
So I mean, a bit of both, because some people for whatever reason, one reason or another, they just feel comfortable having an agent in between. And so I did one deal where I talked to the seller and I said, hey, look, I would prefer use an attorney because I'd rather spend $1,000 on a really good contract than $15,000 on a 6% that you're going to pay some realtor fee, right? That's just, again, I can sometimes bash realtors, but that's because I have a lot of friends that are realtors. And I think an attorney is a much better position to write your contract. But anyway, so some people just prefer that. So the answer is yes, I have gone through that. What I'll say is in that case, a transaction agent is different in the commercial world than it is in the residential world. So if you're buying a single family home and someone brings an agent, in that case, I usually say it's kind of okay, probably good to have your own representation. Not that you need more fees in there, but once they're a transaction agent, they're not really in either one of your best interests. And so they're not really helping you. They're just kind of a mediator. So again, an attorney is going to be a much better person in that scenario, in my opinion. So to answer the question, yes, I did that. I don't really mind having someone in the middle. It just costs money. It's kind of like you're saying, there's no real reason. I think it's important for any audience to know, for some reason, there's like this big cloud above buying real estate, that it's complicated and you have to have all these like things in order. It's like, well, it's really not. It's actually probably just as easy as buying a car. Now, don't get me wrong, the purchase price is quite a bit higher. There's more money involved, so you need to be more careful, but it's really quite easy. I mean, the transaction really is no different than any other transaction. They're just title company and inspection and some other folks involved that are not hard. So what I'm driving at is it doesn't require an agent ever. And in fact, if you can go direct to seller and you know what you're doing, that's a really great way to save them 3 to 6%. And you guys can both hire an attorney for way less than that and feel more confident and comfortable. And then the title company does really a lot of the work too. So yes, the answer is I would prefer direct to seller. But some people feel more comfortable, and that's fine because I want them to feel comfortable,
Yeah, no, I was only asking because every time I've had in my kind of experience of, which I don't really do it anymore, going if there's the agent there, because usually the agent will throw up roadblocks right away and they're going to push me back, even though you're giving them the idea of an offer, which they should be giving to their client, right? I think they have some issue that they don't think they're going to get paid fully out. I don't know what it is.
I think it's a fear of the unknown is what I see. So like for a long time, I would just call agents, right? Like I would call listings and be like, hey, can you ask them if they'll seller finance? And almost, I'd say 95% of the time they just go, oh no, they're not interested. And I know they never even asked their client. But in reality, what I was hearing was, I don't know how to do that transaction, so I'm just going to say no. And so that would be super frustrating to me. But like, it is your obligation to take this offer to your client. So I would just put in writing, and I would send it to them, be like, you are obligated to give this to them and explain it to them. And I would like make again, I'm like bashing agents here, and that's not really the goal, but it's true that you need to push what you're trying to do. And seller financing is a totally legitimate, really solid way to buy real estate. So I think we've kind of beat this horse to death, but I do think it's important to know what you're up against, know what you're doing first. And then if you're confident, yeah, push them a little bit. If the agent doesn't want to, say, well, I don't really care. You have to give that offer to them. It's actually, they're obligated to.
Yeah. So you can just make an offer, submit it into the agent and go from there. But okay, yeah, perfect. Yeah. Thank you so much for sharing that information with, your prior deals and kind of how you did that, because, that's one roadblock after you start starting, and you know what I mean? Making some money, and now you're running out of money to invest, and using creative financing can be, like you said, a win-win for everybody. So transition to where you are now and what you've got going on. So talk to us about a little bit about what Wild Oak's doing, kind of what your current investment strategy and your criteria for investment is.
Love it. Yeah. We are basically in 3 markets. So we're in Tulsa, which is my personal favorite market. I love everything about investing in that city. We're in some parts of Arkansas, Fort Smith area specifically. And then we're one city in Texas because we have a really outstanding partner there. So our strategy is basically like really focus on the markets we know. And part of the reason those markets are so great is because we have really good property management there. And so if you're starting out in syndication, if you're listening to this, they are your number one partner, number one tool. Have a very good property manager. It will make your life 10 million times easier, because they're the person doing all the leasing, all the evicting, all the collections, really the day-to-day. You might be finding the deal, you might be asset managing, but they're doing the day-to-day. So those are the 3 markets we're in. We actually find a pretty nice niche in like a 50 to 120 unit deals. Lots of folks are looking for 100, even 150 more units more. And we're like, we're actually okay with that a little bit smaller. Again, because our management's okay with that. So we have several properties that are like around 50 units, and our manager can do part-time for the leasing agent, part-time for kind of the maintenance. That's what you hear. You want to go for 100 or more, then you can afford payroll. And so in this case, if you have under 100, make sure that your manager can do that. But that's kind of our niche. The other nice thing about those properties is, let's say, for example, we just closed on an 80 unit for about $4.5 million. And the purchase price makes it easier to raise the capital amount needed. And we don't have to go to other people like funds of funds or, prev equity, like those kinds of things. I've kind of shy away from. I don't need other partners in the deal that we don't know really, really well. So we can kind of raise the money in-house. We can purchase the deal. We have very, very good management. There's actually less competition under 100 units. So maybe I'm like tipping my cards here, but that's where we are. And that's the current investment strategy. It's worked really well for us. And to your point, we've slowed down buying a little bit. Now we're ramping back up. We're seeing deals really, really strongly now. But in 24 specifically, it was pretty rough for multifamily. Deals just didn't pencil. And so we're not going to buy deals that don't work just to buy deals. So I'm kind of with you on that.
So one thing here with kind of like when you're in that area with property management, because this is obviously, like you said, the on-site property management, the first couple of deals that we syndicated, we had under 100 units. And, there's always that issue of running the on-site management, having the leasing person, the handyman, kind of figure all that stuff out, or text, whatever. And how do you do that? So you don't have anybody full-time, you just have part-time people in, say, a 50 or 80, like say the 80 unit property. How do you have that? I mean, that's probably big enough where you can have a full-time person, correct?
80 is big enough. That one we have full-time. You have to be really careful. You just have to underwrite your payroll to what it is, because the payroll is going to cost the same for 80 units as it does 120. So it's just going to be expensive, for what it is per unit. So you have to recognize, okay, a person's salary is going to be the same whether they're managing 80 or 120. But yes, so to answer your question, what we normally do is we'll split it. So we'll say either our property manager is amazing. She'll take our property and either another one we own. Let's say we have a 48. So for example, we have a 48 and a 48. But before we had both, we just had the 148 unit property, right? So she said, okay, we'll go half time with yours and half time with another client we have that has like a 60 unit. And to answer your question, yeah, they would be literally on our property half of the time and on the other property half the time. So we would do like 8 to noon or something. So we just have like a big sign on the door that's like, leasing agent here, 8 to noon. If we're not here, call this number or whatever. Or there's all the virtual stuff you can do now, but it is nice to have a person there, right? Or even better is for tenants. So if tenants have a problem, they can come talk to the leasing agent or whatever. And that's nice, right? same goes for maintenance. So a maintenance person you can't afford them full time on a 48, 50 unit property. So you can split them with another property. So that's what our manager does. And it works really well because the payroll is half the price, which makes sense because it's half the size, but that's hard to find. In certain markets, there's not managers that will do that. Or maybe they're new and they don't have another property to split that person with, right? So you have some hurdles, but just to be really, really clear, if you're going for an under, let's say 80 unit property, payroll is going to be expensive if they're there full time. Or be clear with your manager, hey, can we have someone part-time there and see if they can help you out?
Yeah, that's a great tool, great thing to say, because that was the issue we had. They wouldn't split like that. So it got expensive.
Yeah, we've had that problem too. I mean, we had a 32 unit and it was really challenging. I mean, it was too expensive to have someone there and it was too risky not to have anybody there. So it was kind of this really weird thing. And so we kind of landed on part-time and it's worked okay, but it's still pretty expensive for 32 units. So I will say there is a threshold where people ask me, like, should I go for 20 units? I'm like, man, that is a hard size, actually. Like, I would personally prefer to manage a 100 unit property than a 25 unit property. Now, the capital might be easier to raise, but it's just an easier deal. You're going to get better leasing, better maintenance, you can afford the payroll. So that's another tip as well. If you can't raise the capital, partner with someone who you really like and know. And that's really the other tip to multifamilies. It's a team sport. It really is. I mean, you got to have partners in pretty much every regard. And so finding people who can do the things you can't is really the major tip to becoming a syndicator.
Yeah. On our first syndication deal, the main property was a 32 with on-site office. And then what we did to kind of spread that a little bit more, scale it, I guess, a little bit, we bought another portfolio of quads and a 3 unit around that, 27 units. So we had 59 units. And that took down the burn a little bit. You know what I mean? But it's still.
Yeah, well, because then it's cool if the people live in that house, they can go to that leasing agent too, So that's a really smart idea.
Yeah. So you had one leasing agent and it was kind of like, it's surrounded as best we could when we bought it. And so I guess, the only thing, I mean, the thing with buying small is just like, you just have to like really scale it fast if you want to get that third party. If you're managing yourself, then you can kind of do whatever you want. But if your like real goal is to get like real third party manager on there, I have understood it's like, you got to like scale in like a somewhat of a close area as soon as possible. And
or buy a
large property first. Or buy a large property.
Which I know is daunting at first, right? But it is kind of cliche, but it is easier, in my opinion, to run 100 than it is 25. It's just harder to purchase.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So Eric, what would be your advice for investors looking to hire a property management firm? How did you do it? How did you find them? How do you vet them?
Yeah, my number one tip for this is to call every broker you can find in that market. So let's say it's Kansas City. Get on LoopNet or Crexi or whatever if you're new and look at all of the agents, brokers. Call all of them. First of all, introduce yourself and say, hey, I'm looking for a deal. Get on their email list. So that's a good exercise anyway. But before you hang up the phone, say, hey, by the way, who's your preferred property manager in this market? And if you ask 10 people, probably 6 of them will say the same name, right? And that is your person. So let the brokers or the people in the market kind of do the vetting for you. Obviously, then you want to talk to that property manager, explain what your goals are, explain how you're going to work, ask all those questions about fees and how they work and will they take on new people and all those things. But let the market people tell you, who's the best. You just ask as many people as you can, and pretty soon it'll point to the best property manager. Then from there, you can bet them. A good property manager also will take the time to look at your deals that you're close to purchasing. So I kind of caution people, don't waste your property manager's time. But if you have an accepted LOI, they need to be looking at your underwriting immediately before you sign the PSA. In fact, even as we're approaching best and final, we're letting our manager know, hey, we're looking at this deal. Here's our general lease numbers. Do you agree? And a good manager will be like, yeah, I agree, or no, or, oh, no, that's a terrible neighborhood, or, oh, there's tons of crime there, stay away, or you're low on rents, right? You could actually pay a little bit more. I mean, we have that sometimes. So a really good property manager is your friend from even before purchase towards, the end of the deal, right? And so that would be a good way to vet somebody is if you have an accepted LOI, you're close, see how they act when you ask them to look at your underwriting. If they're like, nah, it's annoying, then that's not your PM. If they're on your side and they start looking and they really dive into your numbers, that's a really, really good sign. So those are a couple of tips I have.
Do you walk your units during due diligence with your PM? We've done that before, and pay them, and they know firsthand what's going on, what they're getting into.
100%. Yep. We will pay them, and they don't always charge us. We have enough units with them now. They don't charge us anymore. Early on, it's definitely nice to offer. Say, hey, I'll pay for their time. But yes, I insist on walking every single unit, someone on our team or myself, and the property manager. I'll say, hey, walk 10 or 15. I don't have to walk every single one. I might send them videos or pictures of some really, really rough ones. Inevitably, and this is just a caution and a reality, if you buy a 100-unit property, I can pretty much guarantee you 2 of those in there are going to be real gross. I mean, I hate to say this, but people live in some weird conditions and some sad conditions, and you do see that. So the reality is when you walk 100 units, you're probably going to see some stuff that you wouldn't live in personally. And there's no judgment necessarily unless it's really, really dangerous or, disgusting, but you will find some that are rough and need a lot of work. And so those ones I'll take some photos and send to our manager. But yeah, they definitely need to walk the property, definitely need to see some units. And then we will 100% walk every single one. If the seller refuses to let us in a couple of units, immediate red flag. I'm like, hey, we're not your buyer. We have to see every single one. Some are going to be rough. There could be burn units. There could be, we bought a property that had a meth situation in it, and it was pretty hard to get past. But we did, and it was totally possible. We just needed that disclosed to us so our lender knew. And that type of stuff happens. And so you need to be really transparent with your PM, and you need to see every unit before you buy it for sure.
Yeah. Yeah, I think when we walk them, we grade them, see exactly on our scale of are they 1, 2, or 3? Then we go back and we go, oh, well, there's more units that need a little bit more of a heavy value add when we get to that point with these units. So we have that. And the other thing too is taking a lot of pictures. So we have a couple, you know what I mean? So because you're not going to be in that unit probably for not that often. You know what I mean?
No. Sorry to cut you off, Charles, but when you walk the property, you only have 2 or 3 minutes in someone's place because it's a little uncomfortable and you're in someone's home, right? So what I do is I just literally have my thumb going. There's probably an app that would do this better than me. I'm taking pictures more than one a second as I walk around. I'm always very courteous to people and asking, hey, can I open the store? And, letting people know you're on their side. We're going to try and improve the property, but taking 1 million pictures and then you file those and categorize them later. But the more pictures you can take on that walk, the better. Because to your point, you may never enter that unit again, other than smoke alarms and a yearly, maintenance type thing or whatever.
Dryer vents.
Nice. Yeah, it's nice to have documentation of what they look like. And then as they're coming due, you can share that with your manager and say, hey, here's what this looks like. Heads up, this one's going to be rough. They usually know. A good manager will do usually a 30 or 60 day prior to move out walk, and they'll know what it looks like. But it's nice to have all those photos during your walk anyway.
Yeah. The other thing too is if you are doing this, take pictures of the door number, of the unit number before you start taking pictures, or you are going to have yourself quite a mess.
I always take 2 or 3 pictures of the door number on my way in, and then I say, okay, take a bunch of photos, and then the door number on the way out, and then the door number on the way in. So Yeah, that's a good trick to bookend the photos because they all look the same.
So let's just talk a little bit about your team. I know we're going to like one more thing is just about, you guys are really thorough with property management, with your asset management. What is kind of like what you consider the roles of asset management? What is your kind of a weekly or monthly overview of working with your PM kind of entail?
Yeah, good question. So we have honed this in pretty seriously. And I will back up a little bit. There are basically, in my opinion, 3 roles. They don't have to be taken by 3 people, but there's basically 3 roles to multifamily. One is asset management. She just asked about. Incredibly important. That person needs to be super detailed, open to looking at a lot of Excel documents, looking at your projections versus where you are, those kinds of things. The second one is raising capital. It's incredibly challenging right now to raise capital. I don't care who you are. I just had a mastermind with someone yesterday who's raised a ton of capital. He's like, it's really hard right now. It's just a challenge. So someone who needs to be able to raise capital. Again, that could be multiple people. And the third is basically a person who is good at communication. So it could be investor communication, talking to brokers, acquisitions. Those are the 3 kind of roles, so to speak, and they can be mixed with several people. So our team looks like Bonnie is our asset manager. She's outstanding. She's really detailed. She's great. Shane's kind of the behind the scenes person. So he does all of the things that you don't hear about, right? Like lending. And again, all of the paperwork and all that stuff. And then the third person or thing that and that's actually the other thing I was going to say was you need someone who's pretty detailed, right? Dealing with all the paperwork, making sure all the documents are in order. And then myself and my brother, and I'm usually I'm more into the acquisition side and communication with investors. And my brother's kind of like our capital raiser, also helps with asset management. So there's kind of 4 on our team. It does intermix with other folks as we need. But to answer your question about asset management, we have basically a weekly call for every property. It's pretty fast because you can go through pretty quickly, but we have basically a tracker, like a KPI tracker. Okay, what's collected? What's outstanding? What is the vacancy? What work orders did you have this week? What is the expected rent? And then any evictions coming up, basically tracking that. Then we take those numbers and we take them and say, okay, where did we project we would be this month? And where are we against that projection? Are we high or low, and why? And that's kind of the basis for asset management, is looking at it a big picture of, all right, we projected we're going to collect 60 grand in rent. We're at 54. Why? Why do we think we can do better than we're doing now? Or, hey, we have $10,000 in outstanding payments. What's going on? Why are the rents late? And that's just asking the property manager, what's going on with the late rents? It's not their fault. Maybe someone has a financial burden. So do we need to help that person? Or maybe someone hasn't paid for 3 months. All right, is it time to start talking about eviction, right? So those are the things that we talk about weekly on every call. They're pretty quick. Unless there's something going on in the project, usually 15 minutes, you can go through weekly about those things I mentioned. So that's kind of what we've done is the manager fills in our KPI tracker, which takes them 3 minutes. Then we get on the call, we talk about those things. If there's something that we need or they need, discuss a little bit and move on. I don't think you want to beat it to death. It can be, rushed through pretty quickly so long as you're on track. And then once you get off track, then the harder conversations start of, okay, what do we need to do to change? What do tenants need? What are we missing? Do we need more capital? Do we need to improve some things? There's you get deeper from there, but usually 90% of projects are going to be fairly on par with what you thought unless something's going wrong.
Awesome. Yeah. Well, thank you so much for breaking down that. So let's talk about what you're doing now. 14 months ago, you moved to Spain with your family. Can you tell us about how your experience has been so far and what really inspired you to make the move?
Yeah. Originally my wife and I, we love to travel and we're kind of like adventurous people. When you have kids, you kind of settle down a little bit, but as they were getting a little older, our kids are 5 and 8 now. They were 4 and 7 at the time we moved. We're like, man, now's a really actually good time for us to kind of explore the world because they don't have like a million sports. They don't their friends are kind of malleable at that age. I mean, it's true that kids just kind of get along and they move easily. And so it's kind of a now or never thing. So what originally we thought to do was just move to a different country for each summer. So we're like, oh, let's just move abroad somewhere for a month or 2 each summer. So we did that. We went to Mexico for 5 weeks the summer before we moved here. And that was pretty cool, but it's not long enough. So we're let's go somewhere for a year was the idea. So we did want to learn Spanish a little more. We did want to be in Europe, so it kind of pushed us to Spain. Beautiful country. Anyway, I've never been. It's an amazing place. So we decided to move to Spain, and we got a visa for 3 years just in case we wanted to stay longer. And the visa process is not terribly complicated, but it's not easy either. But anyway, so we've been here a year, and so we decided about halfway through, like, okay, well, we're enjoying it. Kids are enjoying it. Let's stay another year. So we decided in the second year, which we just started our second school year for the kids. So we have a third year potentially, or we can move back to Colorado. We know we'll land back in the States. We want to raise our kids there. We love where we live. We just wanted to show them a kind of a different culture and style. And, it's kind of cool just to let kids know there's lots of other world out there. And for us too. I mean, we get to see different food and culture and language and all that stuff, and we really enjoy it.
So you still have your house in Colorado? You're renting it out or Airbnb it, or?
Yep, which is kind of cool. I mean, we rent our house, and all cards on the table. We're getting quite a bit more rent on our mortgage, so we are making money in our house at home, and it's significantly cheaper to live in Spain. So it's worked out financially. And what's crazy is my team has been really cool. Like, I'm like, hey, I'm overseas, so I kind of have to take meetings in the mornings. So we kind of set up all of our property meetings in the mornings in the States, and everyone's kind of okay with it, and I was really transparent. Like, I'll be super available if you need. I'll leave my phone on loud during the night. Don't call me if you don't need to, but and then it just works well for our team. So I can do acquisitions from here, and Bonnie can do asset management from Colorado, and Shane lives in Tulsa, and my brother lives in Denver. So we're kind of scattered anyway. So it just kind of works out.
So you're 7 hours from Colorado? Is that what it is?
8 from Colorado. Yep,
it's
7 hours.
Okay, so you're 6 hours ahead of the East Coast. Okay.
You got it. Yeah, which actually, isn't too bad. Like, you do a 2 p.m. meeting in East Coast, it's 8 p.m. here. It's not ridiculous. You just kind of get used to that shift a little bit.
Yeah, no, my wife and I travel. I'm an Italian citizen. My wife just took her language test, so we're waiting for her passport to come through.
Oh, man, that's awesome.
So she's pushing to move to Italy next year. So we're putting that all together. But anyway, the thing is that when I would work, we'd go for like 3 weeks to a month to Italy at a time. And yes, I'm used to the whole game, the whole 6 hours behind kind of thing. And, you have to like set one day where you're going later on calls and another, but it works. I mean, it sounds kind of like, but it, everybody. And the other thing too is that Spain and everything is like, they're like hours behind us with how stuff is done. Same in Italy. You know what I mean? Like, dinner is much later than it is there. You know what I mean? So it's not like a huge difference. Like, you know what I mean? It's maybe just a half that time, really.
Yeah, exactly. I mean, the average dinner in Spain is going to be like 9 or 10. And so that's just, dinner time is just super, super late. So yeah, I mean, I think you're exactly right. A good friend of ours just moved to Italy. Actually, we're just there like 2 weeks ago, and they love it. We love that country too. So but it'll be great. If you have any questions, anytime, reach out.
Yeah, definitely. Just one last thing, because, taxes, it's a very complicated thing. And I just wonder, for people that want to do this move, I mean, you have dozen, different businesses, syndications, K1s. I mean, I imagine it's a nightmare if you lived in America. How does that work now? Because obviously you're a visa. So, you have some sort of work visa over there. So obviously you have to at least file something with them or pay something, whatever it is. Like, your accountant back in the States was fine with doing this. It's the complicated thing. Do you have an accountant over in Spain as well? And how do you find them?
Yeah, good question. I mean, you and I both probably have a significantly more complicated tax situation than most people, right? If you have a W-2, you can have a visa, you can work in the States, super simple. I will tell you, you will pay significantly more tax. Now, it costs about half the price to live in Spain as it does to live in Colorado, across the board. I mean, name anything except for gasoline, it costs half the price. You go get groceries, it's 40% of the cost is in the States. And I'm talking like Whole Foods. Like, it's very good food for very cheap, very amazing living for very cheap. But in Spain, you're going to pay 49% tax on your income. So it is an enormous number. So to answer the question, yes, the way it works is you pay taxes in Spain. So let's say you make $100,000. You're going to pay $50,000 of that to the government. But the way it works is you pay first in Spain, and then if there's more, would you have to pay in the States, which is super rare, you get a credit, and so you don't double pay, and then you pay the reserve. If you overpay, you actually get a credit in reverse, which you can use on your taxes in the future. So you're actually, if you're going to remain a tax resident of the United States, or if you're going to return to the United States, then you're going to pay in the long term, you're going to pay a United States rate. If you're going to live in Europe long term, yes, you have to pay taxes, at least in Spain, you have to pay taxes on the money you make. Now, it's more complicated than that. The money we make is in businesses. So there are ways to pay less as a business, but the total perfect way to do it would be to claim it all and pay their rate. And it's definitely painful.
So do you have, obviously you have an accountant here. Do you have an accountant there?
Oh yeah. So to answer the question, we have both. So they work together. So basically my accountant at home is like, I don't do that overseas stuff. She's amazing, don't be wrong, but she's just like not my forte. So there's there's an accountant here who does that for a living, does like international stuff. So I'm using that person. He will file in Spain, and then my accountant in the States will just take that Spain filing and go from there. And so she was comfortable saying, all right, as long as you have the filing, I can take that and go with it. So that's another step. The tax situation's kind of a tricky one. Now, some people, you only have to live, like if you're living less than 6 months per year here, you don't have to pay taxes. So lots of people I know will live in Spain for like 5 months and 30 days, leave and go somewhere else and then come back. And that's a pretty tough thing to do with kids. So that's not a great strategy in our situation, but it does work.
Interesting. Well, thank you so much for coming on. Before I let you go, I want you to talk a little bit about your coaching and then how people can learn more about what you've got going on with your firm.
Cool. Yeah, I love that. I mean, Wild Oak Capital is wildoakcapital.com. So if you're interested to invest, reach out there anytime. Even if you're just interested to talk about real estate, reach out there. My email is Eric, ERIC, at wildoakcapital.com. If you want to learn about coaching, the website is ericnelsoncoaching.com. Basically, what I've done is I've created a group, right? A mastermind of people looking to do the same thing. I will one-on-one coach some people, but in the mastermind, we provide a ton of education. We have a weekly call. That's a cheaper kind of more broad approach to education. And also you have like built-in partners. So I really love the mastermind. I wish I would have had something like that. So that's kind of what I'm doing is creating a group of people learning together. So again, it's ericnelsoncoaching.com. You can see the mastermind in there too, but appreciate you letting me pitch that. I think it's really important to get educated. So that's the most valuable thing you can do. Step one is to learn what you're doing.
Fantastic. Well, Eric, I won't keep you any longer. Thank you so much for coming on today. We'll put all those links into the show notes and looking forward to connecting with you here in Europe or back stateside.
Sounds good. Thanks for having me. Appreciate it.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.